Hello traders, this is Fawad Razakzada, market analyst for City Index. Today is the 14th of Feb 2024. Following the strong CPI report on Tuesday, the dollar index broke above the shaded blue area where it had previously found resistance, including back in December when it staged a sharp sell-off. Now that we are back above that area, this is clearly a bullish technical development, meaning that the path of least resistance on the dollar is to the upside for as long as we remain above this area. So the line in the sand for me now is the low from earlier this week at 103.90, and if we were to break below that level, then I think that would be a bearish development. Now, assuming that doesn't happen, we could see 105.65 next, which was previously support on the dollar index, and above that there's not much further resistance or obvious resistance levels until 107.35, which was the high from October of last year. The euro dollar has bounced back a little bit off its earlier lows, but essentially the trend remains bearish following the breakdown on the back of the CPI data. The shaded area is where previously the euro dollar had found support from. Strong support back in December and not so strong last week before breaking lower. So this area is now going to be key resistance between 107.20 to 107.55 area. The line in the sand now is at 108, which was the high from earlier this week, and a daily close above that level I think would be a bullish technical development. Assuming that doesn't happen, we could see 106.70 next, this blue line here. Below that 105.80, the high of this hammer candle could be the next downside target. Then the key level below that is at 105, the next psychologically important level where the euro dollar had previously found a strong support and resistance in the past. So that's the next major target on the downside. So let's see if the euro dollar will get to 105 in the next few days or weeks even, or whether we will get a quick recovery and a move back above 108. For that to happen, we'll need to see significantly weaker US data from now on, which appears unlikely given the recent strong trend of US data. So that should keep the euro dollar in a bearish mode, I would imagine. The dollar yen is looking quite strong. It's approaching the November 2023 high. In fact, we have a double top there. Remember, in October of 2022, the dollar yen created a high there as well. So the level I'm talking about is at around 151.90-ish to 151.95, that kind of area. The way price is shaping up, it looks like we will get a continuation of this rally and a potential move above that area, possibly as early as later today or later on in the week. Given these higher highs and higher lows, the technical path of least resistance is clearly to the upside and will remain that way unless we see a bearish reversal pattern emerge in the next few days. And for me, a bearish reversal would be potentially a move back below Tuesday's thrust candle. So a move below that on a daily closing basis would be bearish for me. The low of that candle is at 149.20. So that's the line in the sand, at least in so far the short term is concerned. But we'll cross that bridge if and when we get there. For now, the path of least resistance is clearly to the upside. Now, turning our focus on the stock markets, the S&P 500 fell sharply in reaction to the CPI data, as did all the other major US indices, before bouncing back. We've seen this kind of price action in recent times where a couple of days of selling has been met with a strong buying pressure. And so far, it looks like that trend is still in play. However, if we now get a break below some short-term support levels and some real commitment from the sellers, then that is what many people would consider a bearish reversal. So for the S&P 500, this black line here at 49.17, which is where we also have the 21-day exponential moving average coming into play. A potential move below that on a daily closing basis, I think would signal a strong bearish signal, especially in light of the index's failure to hold above the key psychologically important level of 5,000 earlier this week. Speaking of the 5,000 level, if the S&P were to go back above that level and close above it, this will surely keep the bullish trend intact for a while yet. but the market is looking quite overbought and overstretched, so the risks are probably skewed to the downside from here. The Nasdaq also fell yesterday, and it has bounced from the bullish trend line that has been in place since October. This trend line is going to be important to watch. If we break below it now, I think that would be quite bearish in the short term, which could then pave the way for a potential drop back down to this shaded blue area where the market had previously found resistance back in December and in November of 2021. That area between 16,760-ish to 16,970 is a very important, a pivotal zone, if you like. So it's possible we could see the Nasdaq, if it gets to that area, potentially bounce from there. But if it doesn't, and if we go below that area at some point in the future, then that would be a bearish reversal signal. And so far as the short term is concerned, this bullish trend line is what you need to watch closely. The low from Tuesday's range comes in at 17,473. So let's see whether we will break this level today or continue to hold above it. For more market analysis and insights, make sure to check out the news and analysis section at cityindex.com.